Good morning, traders. Are you guys ready to get your morning started with none other than, of course, Joel Elconin, Dennis Dick, and I'm your host here, Money Mitch. Let's go ahead. We got a great show for you guys. Of course, we'll touch on the interest rate hike from the Fed here, the FOMC meeting. We'll also talk about the Swiss bank here with a surprise half-point rate hike. Stick around to hear more about that. Matthew Tuttle, the Chief Executive Officer and Chief Investment Officer, will be joining us from Tuttle Capital Management. We'll talk a little bit about, of course, some SARK action. And I got some questions from Matthew on SOGU. If you don't know what SOGU is, you might want to look that up. But we'll talk a little bit about that with Matthew Tuttle. We got weekless jobless claims, Revlon filing Chapter 11 bankruptcy, earnings on out there from Kroger's. Let's go ahead. Let's dive right into the show. And like always, guys, do us a favor. Start us up with a like button and hit the subscribe below if this is your first time here on Pre-Market Prep.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
How we doing, traders? Let's go ahead. Let's dive right on in. There's a lot going on out there, but it's a tough futures market. Let's go ahead. Let's bring in Joel Elconin and his charts, of course, and Dennis Dick in the back. Let's do it.
Yeah. Hey, I'm gonna be optimistic, man. We're rallying here.
Give me reasons. Give me reasons, please. I want to hear some optimism, Joel.
I'm digging, man. I'm digging here. Big old reversal, just like the last meeting. I'm not even going to talk about the pre-market high. New low for the move, 36.95, and we're just trying to crawl back to yesterday's low. Crude taking a hit too, down to 417 to 111.14. I do have a little green on my screen. That's gold up 430, 1823.90. We'll see how long that lasts. Silver in the red by a couple pennies, 21.40. Bitcoin hanging out here at 21,110, down 515. Ethereum futures, they're down 53 at 1117.50. And I don't know if you want to blame it on the Swiss bank. I guess we've got a lot of different things going on, but that surprise half-point rate hike in the middle of the night, man. That on top of the 3/4 hike by the Fed yesterday. There's other places to put your money, Dennis, instead of the stock market.
Yeah.
Right. Which one do we want to get into first? Which one we want to touch first?
Jumping right into the Swiss because
let's do the Swiss first.
Yeah,
let's do the Swiss. Let's do it. So the Swiss bank here, National Bank, overnight raising rates for the first time in 15 years. Swiss National Bank hike rate half a point here. The Swiss bank also raised its policy interest rate and joining other central banks in tightening monetary policy to fight the resurgence in inflation and sending the safe haven franc sharply higher. The central bank increased its policy rank to minus 25% from a minus 75% level that is deployed since 2015. The hike was the first increase since September 2007.
And the market was holding up. The futures, when I traded from 4 to 8, we were stronger, holding up well. Show the chart of those futures, Joel, the S&P futures. And when this happened overnight, they just pulled the rug out from underneath the market and they started selling, and they never stopped selling pretty much all night here. Incredible that we were up at 38.30 here overnight, and we fell 130 handles from the high, Joel. Is that right? We fell 130 handles from the high overnight.
148.
148 handles from the high.
Yeah.
After the Fed. I mean, this is the market where you got to take the money and run. When you get a pop yesterday off the Fed, you got to take the chips off the table.
We got to start a song like that, Dennis. Take the money and run.
I mean, yeah, exactly. Steve Miller Band. I mean, we've got to start following the Steve Miller Band. It's been the Tom Petty market for a while, but follow the Steve Miller Band. You get the pop in your stock, you take the money and run, because eventually the market just takes it away from you. I mean, this is going for all stocks that seem to get pops, even on earnings. Eventually, they just give it back. And I mean, it's disappointing to say that. You want to say like, oh, there's going to be, no, it's one of these is going to hold. But I mean, look at Oracle 2 days ago. Oracle, nice pop, 63.76, all the way up to 72. Now you're at 68. And you start thinking, okay, well, now we're giving half of it back. When's FedEx going to do it? FedEx, hell of a day. Crazy move, crazy 2-day move. But you just start thinking, well, is it going to start giving it back? Probably. So, I mean, this is the market where you got to take the money and run. And it's a tough investing environment. I wish I was 100% cash. If you are 100% cash, congratulations, you're a genius. Like I said, I've been 42, 45% cash, bouncing around in the 40s. It's not enough, because my portfolio, long-term portfolio, continues to get hit hard. Shocking, that it can get hit that hard with that much cash, but it is, and that's because the stocks are really getting hit. So I think we need to stop thinking about where the bottom is and start selling into rallies if you're too much invested to raise cash, because I don't think the bottom is coming anytime soon.
What about Craig Johnson when he came on? Remember, we were just kind of hanging up there, and he overall bullish, projection, but I thought he said 3,600, and then he was.
I said 38. Did he say 36?
38? Was it 38?
I can't remember. Craig is good, man. Craig's been one of the ones that have called everything well, so it's hard to fade Craig, but I don't, he's saying we could hit all-time highs by the end of the year.
Yeah.
I just disagree with Craig on that. I think you could see the 3,800, the 3,600. I think you could see 3,400 or 3,200 too. It's hard to imagine the scenario where we go back to all-time highs, unless we just get the inflation in check and then they start lowering rates back down, and all of a sudden, the party's back on. But with the free money party over, and this is the big difference, investors, traders that started in the last 10 years haven't been through all this. This has been a free money market here since the financial crisis, and even longer than that, really. But I mean, the free money party is over. So how many companies are reliant on cheap capital to survive, or cheap capital to grow, and are going to struggle to get that capital? Mitch is saying that's the concern. We can move into Revlon here overnight. We get one bankruptcy, REV officially declaring Chapter 11 here, Mitch. Yep. How many more? I'm asking you, Mitch. You were saying yesterday on the show you think there's a lot more to come. I agree with you.
Yeah, I mean, I think this is just the beginning, and one of the things that you got to really start seeing, and you can start taking a look at the financials, is how long can that cash survive before they need to start raising more, right? And when you go to raise more, what valuations you're going to be able to raise it? So definitely, that's what I think the next thing that we need to start watching. Even like higher companies, right? They're going to start trying to probably raise at lower valuations that could put some debt ceilings on them. So just as something to keep on watch.
I mean, it's just something to think about. Like and it's natural human tendency to look where a stock was and say, wow, I'm buying it here. Eventually it's going to get back there, and look at that money that I'm going to make when it gets back there. But we're not in Kansas anymore. We're not in a free market money environment anymore. And stuff is getting ugly. I mean, but we're early yet. That's why, like you think, oh yeah, people are still doing stuff. It's big. We're not going to go into recession. Do you know how early it is? We only raised rates 2 months. When did we start raising rates? 2 months ago? People haven't been hit yet. Their variables up for a month or two. So they start, first thing you do, you leave a little bit more on your credit card. Credit card debt starts to go up. We've started to see that. The next thing you do is, if there's any personal lines, you use that. Then you start selling the toys. And eventually then you start stopping doing stuff. And that's what's going to eventually happen if they have to keep rates up for the foreseeable future. If they can get inflation in check and get the rates, stop going up and eventually start to come back down, then maybe the party can continue. But I just don't see that happening. Inflation is sticky here right now. It's going to be hard to get it back in check. And that's why it's hard to just jump in and say, oh yeah, this is the bottom, let's buy stocks. I'm looking at this market environment from a completely different perspective, that there is a lot of risk in this market. And I'm not sure I want to take on all this risk.
Well, first we got to get rates to stop going up. right? It just plateau. So
Yes.
yeah, I mean, for them to be going down, I don't think that's going to be happening for a while. Also, what you got to have in the back of your mind too is we're coming up on another earnings season here in the middle of July, and we've already have been told by Microsoft. We've already been told who else was another company that, hey, things are not going to be so peachy keen. That's just a couple companies from the dollar effect. So coming into an earnings season with already lowered expectations, I don't know. I mean, it's hard. It's hard to see, just like just boom, hitting a magic number and just turned around on a day like today. Yeah, you could say capitulation. You could say, you say what you want, but until this market, we got to calm down. And I didn't even like that price action yesterday. Just to take off on that. Just think of the absurdity of that. They raised rates 3/4 of a point, and they rally the market like that. I mean, like
And they say they're
everything
going to
is
raise three
fixed in one.
quarters next meeting,
Yeah,
maybe.
everything's perfect because they're raising rates. It makes absolute no sense. And then with the Swiss are fighting back, right? I showed you the chart of the Swiss franc there. They're defending their currency, and all the other troubles with
Well,
their
everybody's
economy.
fighting the same fight, Joel. There's
Yeah,
just inflation everywhere. This isn't a U.S. problem. This isn't a North America
world
problem. This is a
problem.
world problem.
Exactly.
We're fighting inflation everywhere. Japan's just, they're just stuck their head in the sand and they're not looking at it. But I mean, Europe is now realizing, yeah, okay, we have an inflation problem. We got to start jacking up rates. What is the repercussions, though? Just stop and analyze the repercussions from sustained rate increases. Everybody's on debt. Everybody will have less money to spend. We were, saying yesterday with the banks, the way they continue to go down, you would think logically, if the rates are going up, the banks are going to be making more money. That might be true in the short term, but if they start getting jingle mail, where if rates have to stay up, and don't kid yourself, if rates stay up for, a while, people will start losing their homes. So there's a very fine line here between getting rid of the inflation and then getting the rates back down before people really start to get strapped for cash. And we're already starting to see it. Like talking to my real estate buddy there last night, he had another deal fall apart on him last night. And he's like, it is a mess out there. In Ontario, housing prices dropped 22% since the high. Now, again, a little bit disingenuous of me to say that because they went up so much.
Like
that a
40 or
22%
60%.
fall. But still, 22%, the average median house price has fallen since, the high in February. Which is crazy to think about. That's a serious sell-off, or serious, fall in housing prices. People were buying houses unconditionally because they had to, and now they're having deals fall apart, and you're seeing different things happen where I bought the house unconditionally, but the person who was buying my house had a condition. Now all of a sudden that falls apart, and it starts to snowball. So the real estate's a mess right now, at least in Ontario, and I don't believe this is just an Ontario problem. As rates continue to go up, people afford less houses. This will equal obviously maybe some defaults on some payments. People don't lose their houses in 2 months. They lose their houses after you default on your payment, for a while. So this isn't, I'm not saying this is, imminent. I'm not saying this is happening now, but this is not off the table. So it's not off the table. We could go into a housing crisis here. So we've got to analyze all that and say, how the hell are we getting back to all-time highs? I can't see the formula to get us there. And that's when I hear Craig Johnson. I love Craig. He's been right, but I completely disagree that we're going to be back at all-time highs by the end of the year. Maybe I'm going to be wrong, but I'm on the opposite side of that trade.
All right, I want to drop some numbers here for us here. So the Fed raising, of course, the bench interest rate 3/4 of a point, but there's a lot more here. So this marks the greatest rate increase in 28 years. It brings the benchmark fund rate from a range of 1.5 to 1.75. According to the dot plot by individual members' expectation, the Fed bench rate will end the year at 3.4. And so officials also significantly cutting their outlook for 2022 economic growth, now anticipating 1.7% gain in GDP, down from 2.8 from March. So that's a pretty significant change there in the outlook. Inflation projections also by personal consumption expenditures all rose to 5.2 this year from 4.3, though core inflation, which excludes, of course, where we're seeing a lot of our inflation right now, rapidly rising food and energy costs, indicated 4.3. This was just up 0.2 percentage points from the previous projection. So there was a little bit of relief there in the core number. But definitely, if we're going to get inflation on its way down to 2% and unemployment to 4.1, that's still a historical low level. 3.6 is a historical low in the last century, Powell said. So at a 4.1 unemployment rate with inflation well on its way to 2%, I think that would be a successful outcome. And these were comments by Powell. He said that we're not trying to induce a recession now. So let's be clear about that.
He's trying to get a soft landing. I just don't think the formula is there to get it. And I think everybody can add that up and say, look, you've got everybody strapped with a hell of a lot of debt. That debt has obviously, been, cheap rates have, allowed people to accumulate the debt that they have. And now those cheap rates, you're taking them away. So you just got to think first, you get some demand destruction, but fine line to get the demand destruction to bring the prices down and then not have people, just stop doing stuff. So, I think a recession is imminent. I don't think it's a question of if, it's just a question of how long it takes.
Dennis, I wanted to kind of mention a little bit more about that unemployment. So he's saying that unemployment might jump to 4.1, and that's not that bad of a measure. Do you think that they can have that soft landing there at the 4.1?
Well, if you're just talking, if you're just talking a labor issue, is it possible? I don't know. I'm not an economist, so it's hard for me to say whether we can be, keep those figures down there. But I just see the good times that we've been experiencing, for the last 2, 3, 5 years. It's a different environment. It's a different animal we're dealing with. People will go back to 2018 and say, well, we had a rising interest rate environment in 2018, and we got through that, and then we just started blasting off to new highs. This is what the argument is. The difference was we didn't have inflation in 2018. We had very little inflation. We have a major problem right now. We can see it all around us. They've got to attack it. And the Fed has always had the markets back. What happened in 2018? Markets started going down. Fed starts backing off.
Backed off.
Backed off. That's why we came back. So the Fed can't back off this time, Mitch. This is I think the problem is the Fed is actually not backing up. The Fed is working against this market, and that's scary. We've always been long stock saying, well, we got the Fed put. If the market goes down too much, the Fed, will, come in here, lower rates or do something or print more money to, keep the markets party going. That's not here anymore. And that's a main reason we haven't talked crypto, but one of the main reasons you're probably seeing the crypto sell off as well is there's been the argument, and we've never really given this argument on the show, but there's been the argument that, we're printing money. The whole world's printing money. Well, the printing press slowed down a little bit here. So that gets everybody thinking, oh, I was in crypto because they're inflating everything. Well, all of a sudden, they're trying to go the other way here. So I think a little bit of this crypto sell-off has to do with that as well. But crypto is a risk asset. We know, obviously, it's not simple just to say, that the stuff all moves together. Bitcoin became a risk asset. It wasn't 5 years ago or 3 years ago. It became when the masses got in. So it's a risk asset. It's going to move around with rates, but or with with the overall stock market. But it's difficult to just look at this market and say, oh yeah, we're going to get through this like 2018, and eventually, in a year from now, we'll be back at all-time highs. I don't know if I see it. I think this is going to be longer.
It's a tough environment. What I think has a lot of investors concerned right now is that there's some problems out there that like the Fed can't fix, right? They can go after the inflation, but they can't fix the war in Ukraine, right? They can't. What can they do to control? They can dampen the economy to suppress oil prices. Oil prices have had a nice pullback, but it's it's just a macro environment that if there wasn't the war, if we didn't have the oil concerns, if we didn't have competing, the European economies, having high inflation too, it's just it's the perfect storm. There's so many things going on. They could raise interest rates, but there are things that are just out of his control, and I think that is what rattles investors the most. And
a lot of this is out of their control.
Yeah,
they can control the short-term rates, but they don't control the long end. The long end is pricing it all in for them. So obviously the bond market's done a lot of the work for the Fed. So, that's one good thing. But, at a certain point in time, the wealth effect will come into play too, and that will help the Fed as well. I mean, the stock market continues to go weak enough. That will equal demand destruction as well without even raising rates. So, if we started talking about 3,200 S&P, is the Fed as aggressive on the rate rises? Probably not, because, and all of a sudden, do we get a Fed put back at a certain point in time where, wealth effect comes down enough? Let's just say, this is scenario analysis. I'm not saying it's going to 3,200 or 3,000. I'm not, full on. I'd be 100% cash if I thought we were going to fall another 20% from here. I don't know, and nobody knows anything, but it's a possibility. But if we were to get down there, let's say we give back the entire COVID gain on the S&P, which is reasonable, that would put us 3,300. And they're saying Craig Johnson's price target was 3,500. So 3,500, 3,300 would probably be where we started when we were COVID, before the COVID thing happened. Lots of stocks give back their COVID gains. So another 40 S&P points, 10% down from here sounds reasonable to me. If we started to get really ugly, though, and let's say we started to get down like S&P 3,000, I think the Fed changes their tune, because then the wealth effect starts to be like, oh, we've got serious wealth loss here. That's going to equal demand destruction. So we don't have to raise rates as aggressively. So at a certain point in time, we probably will regain the Fed put, but right now we don't have it. And that's why I think we're going to see, I think we got at least down to 3,500 and, maybe even to 3,200. And then it starts to reevaluate. So hard for me to just get bullish stocks. Let's go in here right now when we're still going down every day. We're still catching people that are trying to buy the dip. And those people are getting, hurt every single day they're doing it.
And I just pulled up the cash there, the monthly cash index, and I put this in a while ago, and I didn't fathom, and I took it off, and couldn't fathom. I mean, you get back half of that COVID move, and you're talking about 3,500 in the S&P, and you've already had some stocks, go back down to the COVID. I mean, Amazon got near there. A couple other stocks got near their COVID lows to see the overall market do that. And whether you have the cash chart up here or I could put the futures, I'm hoping that we're gonna do one of these right here. At least pause, right? And here we had the pause in the action. We had the several days of a trading range consolidation. Interestingly, they took it down the day before the CPI number. I don't know if there was a little leakage or whatever, but they took it down. You got the CPI number. We all know what happened on Monday, Tuesday, a lower low. So what I'm hoping for is, at least 3-4 days of consolidation here, and then maybe poke your head up. It's just a long way to go to get to we got 100 points to go to get back to the highs from Tuesday and Wednesday. And I can be pretty confident to say that's going to be a major
bag holders
hurdle.
all the way up
Yeah,
there. Many bag holders.
People yesterday,
I like what you did in the bottom right-hand chart, Joel, the 50% retracement of the whole entire move from the COVID bottom to obviously, the inflated, top that we had there. And that brings you right to the Craig Johnson number too, because everybody in the chat saying he said 3,500. Craig's awesome. I love Craig. So that brings you right back to that 35. Is that 3,500 I'm seeing there?
Yeah, that's cash.
I get old, Joe. I look at it like close on my vision.
I put the cash up there because the futures roll. But, and we had this debate a while ago, Dennis, and I'm like, and you were like, well, this is kind of like an artificial low, right? Like because of the COVID. And then, obviously we know this is an artificial high up here. Right. And so the market it's coming back to equilibrium. And the monthlies, I mean, there are some monthly support levels here, but right now we're holding yesterday's low. So that's a good thing. But
Mitch, what's your thoughts overall market here too? Because I mean, I jumped through everybody. So I want you to jump in here too, because you've been right. You've been bearish here for a while. You're calling for more bankruptcies here. I mean, what are your thoughts here? How we're saying 3,500 seems like a likely target here, which is another 3% down from where we currently are, or 5% down from where we currently are. No, not even 30.
Yeah, I have that same level drawn on my retracement. I've been drawing that pandemic retracement from the fibs the whole way. I've just been watching that. Once we broke through the 380s, next stop is 350s, at least from the retracement levels, right? Now, one of the things that I would say is I'm actually trying to focus more and more on the market breadth and looking for that real like underneath 10% for the SMA 200 to really show us some real giving up of the bulls. Right now, we're at 14.5%. So 85.5% of stocks are below the SMA 200. If you look at the SMA 50, 15.5% are in the bullish zone. 84.5% are in the bear zone right now. So I want to see this get into the single digits. If I see 9, 8, that's when I'll think that, okay, now we really just every stock is just completely pushed down. Now we could probably start seeing some sideways action so that we could really get that lift. You're not looking for
the
the
capitulation.
Bottom. 100%. That's what I'm looking for. The true capitulation. We've gotten down. I've seen this go to 13%, but I haven't seen it past that level. I think it needs to get into the single digits to really be like, well, I mean, we got less than 10% of stocks in the bullish zone. That would be, for me, the point where I could actually look at the bottom and actually call some bottom action.
So what?
Right.
So that was the first topic. It took 27 minutes.
Yeah.
Let's go on. Let's hit something else here. We're going to throw it back to you, Money Mitch. Where do you want to go?
Okay. All right. So one thing that I would, and you guys can look this up is, and I don't do this often, but I pulled out my economics books. Look up what's called the SAM Rule Recession Indicator. And so what this does is essentially you'll be looking at the jobs numbers to see if we actually start increasing. And I think it's an important thing to take a look at, sometimes learning something new. And so what this does is it looks at the 3-month moving average of the national unemployment rate. If that rises by 0.5 percentage points or relatively to the previous 12 months, that already indicates that we're heading into a recession. Just wanted to kind of throw out.
What is it showing? Do we know what it's showing right now?
Okay, so right now we're heading into that increase. We haven't really seen the kind of, because there's a 3-month moving average competing against it. So I'm going to keep an eye out on that. I'll give you guys the numbers later on stock market movers. If you guys want to go into more of the SAM rule, I'll talk about that with an economical specialist. But just wanted to throw out something to keep an eye out. That's an indicator that economics experts are looking at it right now. So take a look at that.
Still saying we're early though.
Yeah, it's still saying we're early. That's why I want to kind of point. So like if you're looking for ways to find out if we are actually heading towards there, that's an early sign in purely an economic standard there. So it's called the SAM Rule Recession Indicator. Check that out. That's how you spell it, because I know that people are not
taught me
probably
something
get the
new
spell
here,
right.
Mitch. Never
So-
got.
We got some economists in the chat here.
Yeah, there's some people
piping
like
in on
that.
Powell said that yesterday too. They're gonna have to tolerate unemployment going up. It's still at historically low levels, but that, and we're seeing that. I mean, how many companies? I mean, you see it. Robinhood laid off people, right? Coinbase is laying off people. I mean, it's there. I mean, you don't have to. I mean, you can look at your economic rule, but it's in the news. It's in the tape. You see, I still see a lot of hiring, and I'm a little conflicted too about
We
that.
still have a labor shortage.
Yeah, like the full blown recession here. I don't know if you mentioned it, Mitch, or someone else did. Lisa went to get something at like the dollar store. And they said, we're only open from 3 to 7 because we don't have
employees.
Was it you that mentioned
Yeah,
that?
it was me,
Because they don't have
literally.
employees. So
They had the sign on the door closed because we don't got employees to run the store. So
That's scary too.
So hey,
yeah.
that's just how it goes. In a little bit, we'll be getting into an interview with Matthew Tuttle. So stick around, guys. Smash the like button. I can't wait to get into that. We'll talk a little bit about
You think
SARK.
I'm bearish? Wait till you hear from Matt.
I want to talk to him about SOGU. If you guys don't know what SOGU is, just stick around.
Oh yeah. I remember this one.
you see, Dennis. I'm doing a little talk there.
Is this a new? It's a short De-SPAC.
Don't give secrets away, Joel. You got to put that off there.
Okay, get that on. We're talking
You're giving
in a
them too
minute.
much. Let's go towards Kroger really quickly. Let's not go Kroger. So it's moving off of the earnings right now. The earnings EPS here came in at $1.45, beating the $1.30 estimate. Sales were at $44.6 billion, beating the $44.24 billion estimate. But you guys can see it. It's actually trading down here. One of the things is it actually it rises its full year 2022 guidance. So it's interesting seeing this downside action right now. It raised its guidance from 3.85 billion to 3.85, all the way up to 3.95 billion. So a raise on guidance, a beat, but still going down here.
Beat, raise, down. Welcome to a bear market, folks. This is what it's all about. Nobody cares because it's like, one, we don't even know if we believe your guidance because we're going into recession. And then two is you just don't care. We just sell stocks no matter what. So I don't know. Tough. It was up a little bit on the initial report here. I got to sell all spikes. I think this thing got to over $52. So
almost. It did.
On a day you're down 75 S&P points, when your stock goes green, you sell it. That's a rule for you there too.
That's a tough one. That's a tough. I don't think. What could they have done? Literally, what else could they have said?
And you think grocery stores do okay in a recession? People still got to eat, man. So I kind of like Kroger. I like Kroger down like 45. So we're 49. It gets down to 45. Maybe it gets more reasonable. This was one that we talked about like $32, $33 last year.
When
I
did Warren get it?
And I sold it.
Warren's had it for a while.
Yeah, he's had it for a while.
What about Warren, man? Did you see Burke? Have you seen Burke in the last like 2 months? You talk about Kathy getting hit. Warren getting hit.
Even Warren getting hit.
I know.
Even Warren's getting hit, man. When Warren can't hide, I mean, who's going to be able to hide?
A tough market when Berkshire Hathaway falls 20% in 2 months. And I mean, is that right? 360? Yeah, more 40. So you've dropped 80 points there. Wow. He's down about 20. Berkshire Hathaway's down about 25% the last 2.5 months. That's conservative investing right there. Value investing doesn't matter. They come for everything. And that's what we were saying. If it starts to get ugly enough, they come for it all. And everybody is crowding into Berkshire as it made new all-time highs back in April. And all of a sudden,
remember that? It was just going up every day. Was just every day. And these tech stocks were getting absolutely pummeled. But maybe if this is a barometer for the market, I mean, you're coming in at just a ton of monthly support if you are so inclined here, a bunch of monthly lows in brick B. So that is a little bit of a positive point. The other positive point here in the market is we are above yesterday's low, which is good, which is 23.25. Also, who knows what shenanigans are going to take place tomorrow, right, Dennis? A quad witch.
Oh gosh, don't even talk about that.
Yeah. You
got an S&P rebalancing, got the Russell rebalancing the following Friday. We got a recipe for some serious volatility.
Yeah, take cover.
You could have a day like today. Whatever. Who knows? We meander is going to be choppy, and then they decide to juice them up on the open, and you wake up tomorrow and we're up 45 handles. Right back. But, I mean those kinds can happen on expiration. Just go back to the Kroger here. This is why when you look at these moves, like this was a big move, right? A big move. Then you have the counter move, right? The bounce, and it held. But when they don't go back up like to the rebound high, you got to be a little bit concerned. You got the pop off the actual report. Two numbers, and they coincide. This the second low of the move, 47.66, and you got right to 47.28 in the pre-market. So I don't know. I don't think you're going to get a look at that pre-market low today if Mr. Market can hold up.
So 8:35.
Let's do it. It's time to go ahead.
We got a rally going on, man. Maybe
we got a rally.
Woo-hoo!
We got a rally.
We're going unchanged, Dennis.
Let's take a peek. 42
stakes.
I'm going to sell stocks if it goes on.
Show us that. Are we really having a little bounce?
We have a major rally going on, man.
Show the S&P. We see Kroger. We're done with
All
Kroger.
right.
Yeah, look at that big rally.
Go. Look at
that.
All
that green.
Holy, that's a green.
Just don't look left.
I've ever seen it. Wow.
You might see some red.
What is everybody complaining about, man? This market's ripping.
All right, let's go ahead. Let's get into our interview today. We're going to go ahead and I'm excited. I've been talking to Matthew Tuttle since, early into the SPAC game. Then we brought him on here early. I had him on Money Mitch really early with SARK, and then we brought him on to here. So we've been keeping a watch on a lot of these ETFs from Tuttle Capital Management. Let's go ahead. Let's dive on in. Let's bring on Matthew Tuttle. Welcome to the show.
Hey, thanks for having me, guys.
Definitely. Always super excited to talk to you, Matthew. I know the guys probably are going to go ahead and want to talk some SARK first. I'll let them go and lead here, and then I'll jump in here. I want to talk a little bit about some De-SPAC action. But
sure.
All right. I'll let Dennis take lead.
I just want to know, Matt, obviously SARK has been rip-roaring. It's been the best ETF out there to have right now, really, as it obviously goes against ARKK. But what are you thinking here? I mean, we've watched ARKK. The collapse has been nothing short of incredible, really. When you think about we started, the year on ARKK at $150, or actually back to 2021, I guess. But, it started this year, November 120. And we've watched it fall 70%. Do you think, this is oversold now, ARKK, or what are your thoughts here? Or do we still have, a lot of deleveraging still to happen here, and these growth tech stocks are still going to take it on the chin? What are your thoughts?
Yeah, so, my thinking is short term, the markets, including ARKK, are extremely oversold. Doesn't really mean anything. And, in that perspective, you would have expected a bounce today. And, obviously so far we're not getting it. But we think intermediate term, longer term, we got another down leg to go at least in this bear market. And, that's not going to be good for, those types of stocks. Add in kind of the way that they tend to trade where, they're buying things ahead of earnings and, doubling down and in a bull market, great. In a bear market, that's lighter fluid.
I mean, she's obviously, did very well for a number of years here. Obviously, the last 2 years being hit because, a lot of these, valuations on some of these stocks she were buying maybe were just obviously mispriced. But I mean, she's sticking to her guns. Like she said, yesterday, I don't know if you caught her the day before. Again, she's calling for a bottom in the market once again, and she keeps calling for deflation. I mean, she's been, exact wrong side of this argument here for a long time. The market's been doing the exact opposite here. So, I mean, she keeps trying to call a bottom, eventually she's going to get it, isn't she?
Well, yeah, I mean, that's, you've got a whole bunch of people who come on financial news and continually call the bottom, and then one day they get it right and all of a sudden they're a genius. But, she really has no choice. And, if I was a shareholder in ARKK, I'd want her out there calling a bottom. I wouldn't want her out there saying, hey, wow, we got another down leg to go here. I mean, if I'm a shareholder, I don't mind her going out and saying, hey, I'm confident and, in all that. If she wasn't confident, that would scare me a bit.
We're on the line with Matthew Tuttle here, Tuttle Capital Management LLC, and Matt, I just have to just give you a major congratulations here, just because you created a new product here, you caught lightning in the bottle, and I don't know if people realize like how significant the volume is in this ETF. I mean, I'm looking at this from day one. I mean, you were trading, you were under 50,000 shares, and now you're trading a couple million. I think that's just a monumental achievement. I just want to congratulate you on that. But from the volume patterns, are you seeing anything significant? Volume is important as well as price. Are you noticing anything, sticking out on the big volume days, whether they're confirming the price action or not? So just wanted your take on that.
Yeah, so we notice a couple of things. I mean, number one, the volume has been huge. I mean, we're trading 3 to 7 million shares a day.
Unbelievable.
What we're tending to see is not a lot of inflows and outflows. So it's kind of a lot of one person selling to some person who's buying. We're also, though, on the flows, we tend to see it kind of counter trend. So, we tend to get more inflows on days that ARK is doing really well. And, obviously SARK isn't. And then we tend to get the outflows on the day that SARK is up really big. So that's one thing I've noticed. And then also, we launched TARK a couple of weeks ago, which is 2x long ARK. And we see the same thing there. I mean, that's trading over 1 million shares a day. And, we tend to see people, day trading that a lot. And we see people kind of putting money in on days that it's down and taking money out on days it's up.
Matt, let's just talk about, why your ETFs have been so successful, because there's so many people who try to launch ETFs and they come out there and then there's no volume. There's nothing on them. They don't trade and they just sit there. Why have you found success? Is it because you're going after, the sexy stuff? Like, why do you think you found success where other ETF, haven't found as much success?
Yeah, so I kind of look at it differently. I come at it from the standpoint of I'm a trader, and I go out and look at it like what tools would I want, as a trader myself, versus I think the way most people try to come up with ETFs, and so I think that's kind of the biggest reason. So when we came out with SARK, it was really, historically I've used inverse S&P and inverse NASDAQ ETFs to hedge. And, as a hedge, those kind of suck because you're shorting, the FANG stocks, which, I don't want to do. I'd rather short Zoom and Teladoc and, and Roku. But there was no real easy way for me to do it. So, hell, we'll create it. And, so I think that's what's really, led to a lot of the success there.
Yeah, so I have on here on the screen here, I'm putting up all the ETFs that you guys can check on out here, the current strategies. And there's a lot here. So definitely, I want the chat, definitely, if you don't get a chance to, catch all the names here and all the information, go ahead and go to the website. I'll make sure it's in the description below so you guys can check out all these ETFs. One of the things in SARK is that, of course, with the ARKK, is there any particular position that kind of is more of on your radar as you're seeing it really kind of deteriorate?
So it's not one. What I do find interesting is that Tesla's not number one anymore. And if you look at that,
what's number one?
What was that?
What's number one? It's not Tesla. I didn't know that.
No, hold on.
I'll get it right quick here. I'll get the holdings up.
Oh, it's a race. Matt versus Money Mitch to see who can find it faster. I did not know that.
All
like
right,
Roku,
so I got
Teladoc.
I got it here. I'll put it up for us here. So the holdings here, I have them as Zoom being the top holdings right now.
Okay.
So here you guys have it. Zoom being at 10.8%, Tesla at 9.23%, and then Roku slightly behind there at 8.49%.
Yeah. So, I mean, that's something that stands out to me. And at one point, I think, Teladoc and Roku were ahead of Tesla, probably more market decline that brought them back below. Mm-hmm. But, if you look at that portfolio, I mean, and if you said, hey, I put a gun to your head and you got to buy one of those stocks, for me, it'd be Tesla. I mean, I wouldn't buy any of them, but if I had to, I'd buy Tesla. And, and I think a lot of people would agree that's kind of I hate to use the word best with a stock, but it's the best stock in the portfolio and it's been going down, and a lot of the stuff that maybe you would question has been going up. So that sticks out to me. And then if you look at some of these holdings, as far as how much they own of the outstanding, and I just pulled it up. You've got Beam, you've got PagerDuty, CRISPR, Intellia Therapeutics. I mean, they're like 8 to 9% of the outstanding shares in those. And, all sorts of bad things can happen when you own that much, of a company. And, especially it's, in the case of, CRISPR, where it's a big part of the portfolio as well.
So just before we let you go, I know Mitch has another question here. What's your favorite indicator? We're in a bear market here. What are you looking at? What's gonna, what would turn you around as far as, I see you look at the 50-day SMA, S&P. What would poke the bull as opposed to the bear in you?
So I'd want to see all the indexes, the S&P, NASDAQ, Dow, Russell. I'd want to see them above their 200-day moving averages before, I'd be willing to say, all right, this is over. We're on the next leg. And, I think we got a ways to go. But, as always, I would tell people, be flexible, be ready for anything.
All right, I'm going to go ahead and transition us away from SARK, but let's go ahead. Let's talk a little bit about some SPAC game. I know you're going to be talking a little bit later at a SPAC conference, so check that out, guys, so you guys can get some more SPAC information. But when we've talked about this, because you've been on the SPAC attack when we were talking about DSPC, the De-SPAC ETF, and then also the short De-SPAC ETF, SOGU. And so what I kind of, mentioned here on SOGU that I want to thank you. I missed out on the opportunity, but I see it now, and it's always about kind of having learning lessons. But and I've been public about this. I've been stuck with the genie bag. And one thing that I think I made a mistake on there was when that really started turning around, I could see here, okay, SPACs were really starting to turn around, really getting hit, even ones that had good outlooks. And this really could have gave me an opportunity to kind of hedge that bet and making maybe some of the way on the downside back here by maybe using SOGU. And I look back at it. So I just want to tell you, thank you, Matthew, at least for putting this tool out there for investors to have an opportunity to hedge a little bit, especially if they took a lot of these SPAC bets.
Yeah, no, you're welcome. And SOGU actually has done better than SARK from a performance standpoint this year. And, and that's really because as crappy as you think the ARK portfolio is, the SOGU portfolio is worse. I think like 12 of the names the last time I looked were trading under 3. We only have one name trading above 10, and that's Lucid. I think there was one day last week where like 22 of the 25 names went short sale restricted. And we've got a few in there trading under 1. So it's some pretty bad stuff in there.
Yeah, that is for sure. And it's been one of those things that at least I say that we had some opportunities out there to kind of hedge our bets. So thank you for creating the SOGU, and we'll continue watching. I still believe in some of these, but I wanted to tell you that, Matthew, thank you at least for giving us the tools to have both sides of the trade here and continuing to make money.
Well, that's a good point you're making. I mean, a lot of these, ETFs that Matt has created here, you give us both sides, which is nice. So even if you want to be, double long, on the TARK, you can go double long, Kathy. So it's the bull side and the bear side. So obviously, and then the trader can pick what they want to do. So I know like Kathy Wood was, talking about you, Matthew, like about a month ago on CNBC and saying, that you're so confident to bet against, our strategies. But I'm thinking, well, Kathy, do your research, because he's got one that goes double long you as well.
Yeah.
So he's not making a call against you. He's just giving investors the opportunity to bet with you or bet against you. So, I mean, obviously, you're not
just providing tools.
That is
just
what it's all about.
Tools, exactly.
And I'll thank you for sure as a retail trader out there looking for tools to learn how to better hedge our positions. And I think this is definitely one of those ways that I myself took a learning lesson. So thank you, Matthew. All right, guys, we're going to go ahead and wrap on up here with Matthew Tuttle. So definitely look into Tuttle Capital Management and their current strategies out there. Also, check out the FOMO ETF. If you guys want to learn a little bit about that, maybe go to the website. You guys can go to TuttleCap.com to learn all this. And where else could they see you, Matthew? I know you're active on Twitter.
I try to be.
I see you out there.
Just don't say anything negative about Bitcoin. It'd be okay.
All right, Matthew. See you next time. Appreciate
All
it.
right. Thanks, guys.
It looks like there's no FOMO in FOMO.
Yeah, you see that? You see that, FOMO?
Man,
We're gonna call it. We're gonna call it.
Is there the inverse FOMO?
Yeah, we're gonna have to do
Probably
the
is.
inverse FOMO
He
soon.
creates
I'm
it
sure
all, so it
Matthew's
probably
already
is.
writing it down, but we'll see what happens there.
Some of these are thinner, so you got to be careful if you're just trading. Some of them, haven't had as much success, obviously, as the SARK and the TARK. But so you got to be careful when you're trading any of these vehicles. But I mean, what these are, they're trading vehicles, and I respect Matthew that he creates both sides of it. Not just to say, oh yeah, we're just betting against Kathy. I mean, he's got the other side too, the double bets with Kathy. So, and we're still waiting for that Kramer inverse ETF. I don't know if he's going to come out with that or not. That'd be nice.
I know we
Kramer
would all
ETF
jump on
and
that
Kramer,
one.
go with Kramer, you go against Kramer.
But yeah, I had to give him the thanks.
Create a PMP ETF.
Yeah,
you go with Dennis.
Go
with Dennis and Joel and Mitch, or go against Dennis, Joel, and Mitch.
Double leverage Dennis Dick.
They would be flipping so much though, because I flipped so many times. I don't think they'd be able to do it.
It's
long,
the
short.
D,
oh man, he's flipping again. They're
triple D
trading
symbol.
costs and commissions.
You know what? 3D system. I'm sorry, we're gonna have to take that back. You can no longer have 3Ds because there's only one triple D in my eyes, and that's Dennis Dick, baby. Let's go.
Is there a PMP stock? Ho! I better get over to the
baby. You better go.
I better get over to the exchange there and do that. Dennis, what are you seeing out there? I mean, one thing
Chop.
that on the pre-market show, a lot of times you say, man, stuff isn't down enough or stuff is up too much. I'm seeing that, the SPY down about 1.95%, and I see a lot of stocks right there. Apple right there. I mean, so even though we got some big action here, it looks like the ARBs they're doing their job here.
Yeah, they are. And I'm doing that job as well. I mean, this is, sometimes you come in and you see the S&P down 1%. You're like, well, there's not that many stocks down 1%. So then you're, but once you get to like 853, there's enough traders doing enough arbitrage, it starts bringing in. At 7 a.m., you might see a little bit out to lunch. At 6 and 4 or 5 in the morning, you see lots out to lunch. For the simple reason is there's no markets on a lot of stocks. As you start to approach the open, it starts to get more in line. We're more in line here. Now, today, we're very in line. And one other thing to consider, as the VIX goes up, and we're talking about a VIX 31 here right now, which is obviously on the rise, stock correlations all start to come together. So a stock is a stock is a stock. And just like we said, if it gets ugly enough, they hit all stocks. Even though, you look at oil, USO was trading up earlier this morning, all the oil stocks getting hit because they're stocks. Now, USO has rolled over and went negative, but, you logically think that there is definitely a high correlation between oil stocks and oil. But there's also correlation between the S&P and oil stocks. So sometimes you can see instances where oil can actually be going up and the oil stocks are still going down because they're stocks. So right now, it seems to be pretty much in line here. I think the ARBs are doing a good job this morning.
That's a huge lesson there, guys. I'll repeat that. Correlation in these moments is going to be definitely an important thing to understand. Dennis giving some gold this morning like usual. I do want to go ahead and give us the initial jobless claims. It doesn't look like we moved it too much, but initial jobless claims were for June 10, 229,000 versus the 215,000 estimate. Prior was 229,000. So pretty much just another same number reading there, but the estimate was off a little bit there. And then we also got USA housing starts for May at 1.549 million versus 1.7 million estimated. Prior was at 1.7. So less housing starts there, kind of going back to Dennis's.
That's common, man.
Yeah.
That's low hanging fruit. Yeah. Who's starting to build a house right now?
Who's building the house right now? Don't call me.
I'm the only idiot doing that. So still going.
I'm not building, but I'm looking. I'm combing the ditches. I want to see. I want to
literally. That's where you might have to build it, in the ditches.
Yeah. We see a question here, and I finally looked up the date for Google, and I'm seeing July 15th for when that split takes place. So that's still a month away. But I just look at that Amazon pattern. I mean, look at that. How did that come back like to a T?
That was
the way that thing rallied into it, and then that textbook.
That's the textbook split trade. Runs up into the split, tops out day or day after the split and
It
then
was
just tanks. And obviously market was a lot to do with
Yes.
that. So it's market effects. But I mean, that was just classic textbook run up into the split and sell off after the split. And the 100 support, I mean, Amazon is trading very well technically. I do have that small position, my wife's RSP, in the long-term account that I put back in there, and she's slightly down in it. I think we're averaging around, I bought it before the split, I think we're around 110. So 104. So again, what are you not down with? I mean, every single stock that I've bought here in the last, 6 months, my long-term account, I'm red in. It's if you're not red in it, you should sell it.
Are you trading it more now?
No.
Post split?
No, I'm trading so much in my regular account. I'm not. Oh, and I am trading Amazon in my trading account.
Yeah.
I liked it pre-split. It actually, I feel like it's so thick now. It's like I liked it when it was thinner. So, I don't, and obviously now, I have to, if you're doing on commissions or whatever, you buy 100 shares. Now you got to buy 1,000 shares or 2,000 shares, same amount. So your commissions are going to be higher too. I don't like them after split. I like them pre-split. I'd rather trade the $2,000 stock because Amazon was already liquid.
Yeah. All right. We got a few minutes here, Mitch. Did we get to our checklist or only a couple of them?
Yeah, the only thing I will mention there, we touched everything, but I do want to mention after the bell, Adobe will be reporting. So keep that one on your radar. We'll see how that kind of moves.
Tough day.
I don't know, man. Yeah, tough day to report. I don't even know about this one, Adobe. I'm not sure. This is also one of those brands has been around for so long, but that monthly chart. Don't call me on that monthly chart.
I don't think it's expensive. What's the PE on Adobe? You have that, Mitch?
Yeah, I'll
throw you under the bus
quick.
here. Mitch is
I got you. I'll pull it up
stuff,
here while Joel gives us.
I don't think it's crazy anymore. I mean, this stock was $699 down to $367, and I think the valuation, it was always kind of a little bit higher, which is why I didn't go into it. But it's probably coming into reasonableness pretty soon. It's one I would put on my shopping list, I think.
Opening into the low of the move. I mean, that's it. 12,800 shares. So opening right there right now, low of the move, 67.31. Just one comment here in the chat from Afrim about interest rate, dividend paying stocks and those utilities, man. They were hanging out there. They were hanging out there, and they finally came from them. I don't know if the inside
we knew
day
that
yesterday. Yeah, those. So, I mean, you got to be careful. They hiding out, and then get out, and took place in a couple days. So, we'll see. Inside day yesterday. See if we can build a little bit of a base. I'm just looking at the XLU and the preferreds, Dennis.
They're starting to get hit too now.
Yeah. Yep.
This stuff here makes no sense, man. It didn't make any sense. Everybody was hiding in it because it's a stock. I'm going to go in the defensive stocks. But you want to go and buy utility stock for a 4% dividend in a rate environment where you're going to get guaranteed money at 4 or 5%. You're going to be able to get that in another 6 weeks. We're going to hear about GICs in Canada 4.5%, 5%. I mean, that's where we're going. Ontario already said they're going to raise, rates, or Bank of Canada, so they're going to raise rates, and probably in the next 3 weeks to follow the Fed. So, I mean, we're talking 3.75 on a 1 year right now. It's not unreasonable to think we're going to eventually get 5% on government guaranteed money. Yeah. I mean, you want to be in the utility, you want to be in government guaranteed money. XLU dividend 3.05%, not good enough. The growth isn't there. It's not cheap. I think every rally in XLU, and I've been bearish to the utilities for a long time. We know I've sold them. It took a long time to start selling off, but I think the party's just getting started. I think you could see the XLU eventually under 50. Oh, that's a bold call. Wow. I'm not joking. Wow. I think you've got to sell.
Power outage, right.
I would sell all rallies in the utilities. Kathy Wood, absolutely correct. She says there was a bubble in some of these staples and utility stocks and some of the value.
Got that right.
And she was right there. She was right there. There's a bubble in her stocks, but there was a bubble in those stocks too. So, I mean, you just see XLP too. I mean, it's starting to all come off here. Joe Procter Gamble, which we talked about at 160 multiple times, saying, I think eventually this is going to look like Clorox. All of a sudden, you start thinking, Pre-G trained 27, 28 times earnings. I mean, they have some pricing power. Yeah, people are still going to wipe their butt with their toilet paper and still going to, use their Head and Shoulders shampoo. But I mean, still. 27, 28 times earnings, was trading at the peak there, I think. I mean, I don't know. It doesn't sound cheap to me. 2.78% dividend doesn't sound that great to me when we're talking about 4, 5, 6% rates here now. All of a sudden, I think I think you got to sell all rallies in this consumer staples, and obviously oversold a little bit Procter & Gamble, but a lot of people thinking, oh, how can I go wrong? In a rising interest rate environment, the stuff does not work.
So I just wanted to give the numbers there that you asked for on Adobe's PE. Forward looking is 27.54. Industry average, though, is 81.74. Just to give kind of reference to the industry, I think it's important always to look at that industry average. And you can see here, it's not as high as the industry average, but still, I think it needs a little bit more coming down, at least in my eyes, to seem a little bit more attractive. What do you think, Dennis, at that 27.5?
On which Procter & Gamble?
On Adobe.
Oh, Adobe. Sorry, because Joe still has Procter & Gamble chart up there.
No stress. That was my fault. I just wanted to bring us back. You asked for the numbers. I deliver.
Yeah. I don't know what to say. I mean, who knows on these earnings reports? They're complete coin flips. You get good earnings from Kroger and they hit the stock anyways.
Yeah.
So it's hard to say, okay, I'm going to buy it into this and we're going to be okay. I mean, if they miss, it's getting hammered. If they beat, it might not even go up that much. So there's not really a lot of incentive. There was an argument to be short every single stock last earnings into the report, and you probably would have been making money because some of the ones that missed got killed, and the ones that beat went up for a day or two and then eventually came back. Money was being made just being short every single stock in earnings. And this is obviously the tail end of the earnings season here now. We're going to start going in earnings season when we get back in July. So we're at the very end of it. There wasn't any companies really reporting this week. But Adobe, it's a coin flip on what the earnings are. I mean, we did see a good response to the FedEx dividend raise, but I just can't see owning anything ahead of an earnings.
Hey, I got to hop here.
All right, before you hop there, Joel,
yes,
I think
sir.
it's important for me to mention this. So Hertz asks, why don't we have ticker time anymore? Because it goes on. Joel just does it. So go ahead, and if you guys want to stick around with the ticker time, all you got to do is go on over to PreMarket Prep Plus and Joel Elconin. That's exactly why he goes and says, deuces, guys, I got to get on out of here. I got
PreMarketPrep.com. Joel's doing ticker time there. Free,
yeah.
live.
Boom. Go check it out there, guys. If you guys want to go ahead and run through some ticker time. Dennis, thank you like always going through it. Go ahead and battle, and we'll see you next time. Appreciate everything.
Mitch, great job today, buddy.
Let's go.
Okay,
Let's keep it going. All right. Well, let's go ahead like always. And yeah, I know. Bean and rice. It's probably going to be beans and rice for Dennis and I for a little while there. I can't blame him either. He's building a house. I'm over here renting a house and moving. Probably not the right time to do it, but that's all you can do, right? So smash the thumbs on up if you guys appreciated today's show. Let's see if we can get to 600 likes or 800 likes. That's really where we should be at. 50% of you guys should be at least giving us the opinion, whether you like the show or you don't like the show. And if you don't like the show, let us know why. Give us some feedback. We're always trying to improve pre-market prep. We're going to keep battling here on Benzinga to always make it better. Now we're going to get on over to live trading with Zunaid, Lord Ryan, and I. So if you guys want to go ahead and check out some live trading action, come on over there. And later today, of course, I got stock market movers. We'll still be getting into 2 expert opinions. Today, we actually have a SPAC company that we'll be going into, but also be touching a great interview on the backside around 145. Stick around, guys. We got a lot on Benzinga. We're going to keep making things better, but you guys let us know also if you got some feedback to go ahead and do so. So smash the like button and let's keep it going right here on Benzinga.